Fed is expected to cut rates in just a few hours from now, but will it help our foundering mortgage market? Joining us now to break everything down is Bob Moulton. He is the president of Americana Mortgage Group, and Dr. Dani Babb, real estate analyst at drdanielbabb.com. Welcome to both of you, Dani and Bob.
Good morning,
let's clarify one thing. Will a cut in the Fed fund rate today cut mortgage rates? Dani?
Yes, it will, but it's going to take some time. If we have a half-point cut today, it's not going to drop a half a point today. Also, we have to remember that a lot of these adjustable rates are actually tied to the LIBOR price and not to...
Yeah. All right. Yeah. Jargon. LIBOR is the bank lending rate in London.
Right.
Right. And go ahead and continue.
Yeah, so I think that we will see some rates cut. We will see some mortgages, particularly HELOCs, drop, home equity lines of credit. But I don't think we're going to see an initial cut today that's going to make a huge impact.
Yeah, and Bob, expand on that. Home equity line of credit, adjustable rate mortgages, and fixed rate mortgages. Let's be very specific. If the Fed cuts the Fed funds rate, what's going to happen in each of those three?
Well, if the Fed cuts the Fed funds rate today, what will immediately happen is the prime rate will come down. So the prime rate's at 7.5%. So if they cut 50 basis points or 25 basis points, the prime rate will drop to 7.25 or 7, and immediately anyone who has a home equity line of credit will see their payment come down in the following month. Mortgages, first mortgages, I think may have anticipated the Fed funds cut already, because we saw a nice rally in the 10-year Treasury over the last couple of weeks, and we saw the 10-year Treasury under 4%, and there's usually a risk-based premium above the 10-year Treasury to first mortgages, and for the first time in 2 years, we saw 30-year fixed rates under 6%. So those are sort of anticipated. Regarding adjustable rates, I think that will factor in over time and not have the appreciation that you have with the home equity lines of credit.
And let's just be absolutely clear. The Fed funds is a short-term interest rate. Mortgage rates tend to be long-term interest rates. Long-term interest rates tend to be set by the markets, by the rates on the 10-year. They're pegged to things like the 10-year Treasury interest rate and the London interbank borrowing rate. So I just want to make sure we're clear on all of that. So if the first people who will benefit from this will be people who have home equity line of credit, and then possibly people who want to have an adjustable rate mortgage or want to get an adjustable rate mortgage?
Well, we saw the 5-year ARM up to $1 million drop to 5.625 last week. So people that are looking at taking out a mortgage for a large amount of money are more inclined to take a 5-year ARM, which is benefiting from the anticipation of the Fed funds cut, because the 30-year jumbo mortgages are about 100 basis points higher.
1%. One percentage point higher.
1%. So from 5 5/8 to 6 5/8. When you translate that into a monthly payment, that can mean significant dollars and cents for home buyers.
So, Dani, one way or another, we are seeing lower interest rates, either with the home equity lines or the adjustables, and the markets are helping to bring down the 30-year fixed rate mortgage. So, is it a good time to possibly buy a house, given the weakness in the housing market and so many homes for sale?
Yeah, I've been saying it's a good time to buy for months, because just like in the stock market, we want to buy low and sell high. And at any time, if you're going to hold your home for the next few years, you're not really going to care about a $5,000 drop in price between now and maybe next spring, for example. I think now is a great time to buy a home, and I'm actively pursuing purchases across the country.
All right. And Bob, real quick, what kind of activity are you seeing? Have you seen people kind of waiting and holding back, or are there a lot of applications at your shop right now?
We had a great November. We were slow, July through October, where there was a lot of, concern with the markets. But there's a lot of pent-up demand there. People are taking a look at, where rates are. Rates are close to a 40-year low. You have prices that are softening up 5% this year, maybe 5% next year. So we are seeing a great November and good December, and hopefully next year.
Yeah, but you're mainly in jumbos. We just want larger mortgages rather than smaller. All right, Dani and Bob, thank you so much for your insights this morning.
Thank you.
And we're just about a little over half an hour away from the opening bell. Money for Breakfast is coming right back. Stay with us.